Finansal düzenleme, para politikası ve finansal istikrar, gelecek dönem konulu oturumu açıyoruz. Sayın Anthony Randazzo'yu öncelikle çağırıyorum, sayın moderatörü ve kendisinin başkanlığında geçecek oturumda Sermaye Piyasası Kurulu Başkanımız Profesör Doktor Vedat Akgiray, Suudi Arabistan'dan BMG Finansal Grup Başkanı ve CEO'su Sayın Basil Ghalayini, Almanya'dan ZEP GmbH firması kurucu ortağı Andreas Rinker ve Türkiye Cumhuriyeti Merkez Bankası Başkan Yardımcısı Doçent Doktor Mehmet Yörükoğlu bu panelde yer alacaklar. I would like to kindly invite the speakers to the panel on the floor, please. One small reminder to the moderator, actually, the panel will need to finish at 13 o'clock sharp for the signing ceremony between Istanbul and Bahrain exchanges.
Good afternoon. Hi, my name is Anthony Randazzo. I'm the Director of Economic Research at Reason Foundation. We're a think tank based in Los Angeles, California. I live in New York City. Thank you, Murat, for your invitation to speak today. We have a fantastic panel for you guys this afternoon just before lunch, and I think that if there's going to be 4 people to keep you from lunch, these are the 4 people that we want to keep. You want to stick around to listen. The subject matter is one that has been coming up over and over again this morning, and that is one of stability, financial stability, and we'll focus particularly on Europe. Maybe the conversation will branch a little bit more global depending on where we go. I'm going to start by asking each of our panelists a question sort of as a way of sort of kicking off the conversation, and I'll follow that up, but then we want to open this up to you as an audience. I think there are cards to be able to ask questions, and so we very much encourage asking questions to be able to engage with these 4 very sharp minds up here this afternoon. So let's get right into it. I opened up Yahoo Finance about 5 minutes ago. These are the top 3 headlines. Eurozone to boost bailout fund, firepower 2 trillion euros. German business climate falls despite ECB bond plan. And the Eurozone uncertainty puts shares euro on back foot. Not exactly a pretty picture. And so Professor Dr. Vedat Akgiray is chairman of the Capital Markets Board of Turkey. We'll start with you. We're here to talk about financial stability. What, from your perspective, from capital markets perspective, what does the European Union need to accomplish in order to avoid another crisis, in order to move out of this particular crisis, to avoid destabilizing capital markets? Is the fiscal treaty the answer to this problem?
Thank you very much, and a good afternoon to everybody. It's almost afternoon.
Yeah.
I think I will speak in English. It's okay?
Sure.
It's fine. Okay. Well, Europe is the center of attention these days. It seems it will continue to be. Let me first start with a disclaimer that I'm speaking on my own self, not as a spokesman for the Capital Markets Board of Turkey. So anything I say good is attributable to the CMB. Anything bad is from me. Unlike many others who have to be very balanced in the way they evaluate the events in Europe, I personally I'm very pessimistic about the case of Europe. Pessimistic. I will continue to be pessimistic as long as European policymakers continue the way they have been doing over the last few months. Now, the way I see it from the outside, the events, problems in Europe is that at the beginning of this year, earlier this year, a fiscal treaty was signed by 25 countries. Still, some have to ratify that. ECB, with the new chairman, is very proactive, trying to be very proactive and bring together some kind of monetary union. But I think Europe looks like a geography where there are many opposition parties, but no party in power. That's the way it looks, because countries have their own domestic problems, which can often be decoupled from the overall European problem. As such, a fiscal union, as we may all wish the other way, seems to be very close to an impossibility, in my opinion. Because at the end of the day, politicians will have to get votes, and no single country is to be blamed for the problem. No single country can be the solver of the problem. So it's a politically impossible game, it seems. And without a fiscal common ground, monetary policy is basically a short-run dream. It cannot be effective. If Europe was one country, one state, what had to be done would be very clear and would be simple. But that is not the case. So unless these fiscal treaties, monetary treaties going through unions, to European Union common behavior is accomplished, I will continue to be pessimistic. But the problem in Europe then, if it cannot be solved, then let us not pretend to solve it. Let's let it go. If some institutions, including some states, are to default, let them default maybe. Because from one perspective, this financial crisis that we are still living through can be attributed to some kind of financial euphoria, as in all crises. Okay. Prices go up, bubbles occur. Now we had bubbles, the bubble is burst. Actually, the bubble did not burst, did not blow up, it changed name. There was too much debt, too much value increase because of debt. Institutions failed, payment problems occurred at the sovereign level, and then the central banks and governments issued new debt. Direct or indirectly, they kept the bubble still as a bubble. The name is changed only. Okay? Now, some banks' debt or red numbers became the people's debt and red numbers. It's debt again. At the end of the day, somebody will have to pay for it. Unless and until we know how that will be paid, this thing is not solvable. That's a very tough statement, probably. So the problem goes beyond Europe, but since Europe is the current playground, we are worried. I am worried, not we are. Maybe in the second round we can come to this. A fundamental change in the way we approach to the financial industry, I think is very much needed.
Well, I think that'll be something we definitely want to come back to, that idea of a fundamental change and the idea of letting defaults happen if they need to happen. Before we get to that, though, I wanted to pick up on the monetary policy point that you brought up. And Dr. Mehmet Yörükoğlu, did I get close, maybe? Close? Okay. Not very close? Thank you for being gracious. The deputy governor of the Central Bank of Turkey, which makes my error even all the worse. But picking up on this idea of monetary policy and its effectiveness, it seems that around the world there's not a lot of fiscal action. Central banks are some of the most active, particularly in the United States, the Federal Reserve, most recently the Bank of Japan with their monetary easing. the Central Bank of Turkey and the ECB being engaged in easing for some time now. And this is in some parts an attempt to boost economic growth, but often it's also been a part of influencing financial markets and trying to encourage investment and stability. So from your perspective as central bank, what are some of the benefits of this approach, this sort of like global easing, using monetary policies to try to promote stability and growth? And then a follow-up to that would be, what are some of the risks, the downside of this? Are we creating sort of economic distortions, bubbles, by another name?
Thank you very much. You asked as the Central Bank of Turkey, but I would like to start with the same disclaimer that our chairman, Akgiray, stated. These will be my own views.
I'm not going to be able to get anybody on the record, am I?
No. Now, if these questions, these are really important questions, very important questions, and if these questions were studied before the global financial crisis, especially in the great moderation era, great leveraging era, I believe the global financial crisis could be avoided. Now, I agree that the monetary policy globally, especially in advanced economies, is overburdened. It's taking all the tasks. There is a moral hazard, as the economists say. There is a significant moral hazard problem here. Now, the central banks have to be very careful about financial stability, because their standard classical tool, interest rate, is a very powerful tool. It's a very powerful tool, but it's also a very blunt tool. It affects everything in the economy. It doesn't only affect pricing decisions. It's the single most important hidden hand in the market economy to ensure static and dynamic efficiency in the economy. So if central banks having a power, market power, as an agent having a market power, and it can drive also expectations, uses interest rate in an overburdening way for a very long period of time, it can cause risks for financial stability to accumulate. Now, so central banks not only with their decisions, not only should not only try to ensure price stability, but also financial stability at the same time. But unfortunately, especially for emerging economies, the interest rate that's necessary to ensure price stability may not correspond to the same interest rate that will ensure financial stability. And the problem is, the asymmetry here is financial instability only shows itself after a crisis. You cannot pin down that financial instability like you can pin down price instability. When there is price instability, there is inflation. It's already there. Everybody sees that. But for financial instability, until you have a crisis, you never know. So central banks have to be very careful. And once central banks overburden interest rates for a very long period of time, either way, high interest rates. So let's take central bank out of the economy. What would be the equilibrium interest rate in the economy? If central bank is following a policy that's above that, and if it does this consistently for a very long period of time, it's going to induce distortions and financial instability risks. Similarly, if central bank forces interest rate below otherwise market equilibrium interest rate, then again central bank is overburdening interest rate, And it will create significant distortions, and it will accumulate financial instability risks. So these interest rates that will ensure price stability and interest rate that will ensure financial stability, they may be different. They are usually different. And again, they are different usually in one way. For emerging economies, the wedge is one way, not the other way. So you need other tools to fill this gap between the interest rate that's necessary for financial stability and the interest rate that's necessary for price stability. You need to use other tools besides interest rate. So you should be using a set of complementary tools so that in the end, these two objectives, price stability and financial stability, is ensured with the same interest rate. These, as Central Bank of Turkey, we've been, in the last couple of years, we've been using other tools like reserve requirement ratios, interest rate corridor, and recently now we will start using a new mechanism, reserve option mechanism, to fill this gap. And this gap is bigger in emerging economies compared to advanced economies. So emerging economies need this set of tools more than advanced economies. Now, since you need to use more than one tool, actually things become harder for you. Because there is learning process both on the central bank using these tools and on the agents in the economy, in the financial market especially. And also, communication is more challenging now because you have more than one tool. It's not very clear. Especially, most often, when you have more than one tool, for instance, if you take reserve requirements, most often, as a central bank, what you need to do is, depending on circumstances, you may need to ease on one policy, for instance, interest rate, ease on interest rate dimension, but at the same time, to secure financial stability, you may need to tighten on another policy, let's say reserve requirement ratio. So these are working in opposite directions, but you need to use this way. But it's conflicting. It may seem contradictory and conflicting from the side of the market agents. So communication becomes very important. Under these circumstances, since communication is challenging and learning is needed, the best mechanisms and tools are the ones actually that automatically stabilizes whatever needs to be stabilized. That works through market agents' decisions, market friendly. Our new, because then communication is not that challenging and this learning needs is not that big. Our new tool, reserve option mechanism, is such a tool. In that mechanism, banks decide to use their options themselves. And as they decide to use their options or not, the FX liquidity for them and for the overall market is automatically stabilized. Now, I want to finish. I'm taking long, I know, but I want to finish with an interesting example to these potential distortions from central banks' decisions. I have a couple of slides. If you could put these slides on, I'll try to use those slides. Now, the number one problem in advanced economies right now is unemployment. If you look at actually performance of economic growth, output growth, it's much better compared to the performance of employment in advanced economies. It's unlike Turkish case, as our Deputy Prime Minister stated. Turkish economy is doing really well on employment dimension. But in advanced economies, the big problem is unemployment. So what can overburden central banks' tools in advanced economies is this unemployment problem. They, for instance, in the latest Jackson Hole meeting, unemployment is very widely discussed. And actually the bearish curve shifted in US. And the reason for that was very deeply discussed. The number one problem is unemployment. Let's think about what happens if, let's say, Fed, some central bank, pushes interest rates for a very long period of time, very low, close to zero, to support employment, whether it's going to work or not. Now, the effect of interest rate on employment has three channels. The first channel is the regular channel, what's called internal channel, internal margin, internal channel in economics. When interest rate goes down, investment increases, job opportunities increases, employment increases. But there are also two other channels which work in the long run, not in the short run. And they are actually in opposite direction. If you keep interest rates, so there are distortions in this channel from low interest rates, let's say. The first distortion is on technology choice decisions of firms during investment. If you keep interest rate too low for a long period of time, and if people expect, investors, firms, expect that interest rate will be low for a long period of time ahead also, when they invest, they choose more capital-intensive investments because cost of capital is low, and it's going to stay low for a very long period of time. So they will be choosing technologies and investments that are capital intensive. They are not using too much labor. So actually, they are cutting demand for labor. So actually, economy may grow, but this economy may not create employment. The second channel is distortions on hiring decisions of firms. If cost of capital is low for a very long period of time, the cost of keeping capital idle also decreases. So when a firm is going to hire an employer, when it's going to fill a vacancy, it's going to look at its skills, other things. If leaving capital idle, vacancy idle for a long period of time is low, is the cost. If the cost is low, the firms will be very picky about their employment decisions. They're not going to fill the vacancies as fast as they will. In the end, most of the vacancies may actually stay there because firm waits for a better worker, a better match. So, an outside observer looking at this, so this is the US beverage curve. You see that in the last 3 years, especially, the curve has shifted. We have vacancy, a lot of vacancy around, but this does not turn, these do not turn into employment. So unemployment rate is high compared to the amount of vacancies over there. So an outside observer may think that there is a skill mismatch here. One of the explanations in the Jackson Hole discussions are there is whether it's structural or cyclical, and the structural side says that there is skill mismatch. But skill mismatches do not occur overnight. You cannot expect that to shift beverage curves because it depends on education, everything. That takes time. But if firms behave this way, if they behave picky in their filling vacancies, and if they decide more capital-intensive investments on, then we will see this beverage curve shifting. So actually, currently, I think keeping interest rates low is not very productive for at least US in creating employment.
Sure. Yeah, I actually happen to agree. Federal Reserve does not. But I thank you very much for that, the honesty and sort of like the struggle, the difficulties of monetary policy. It certainly is not very easy. I wish we had you on the record because I'm pretty sure I heard you say that no matter what central banks do, they're going to distort the economy.
If you overburden one tool,
right,
which is very powerful, but that tool is also blunt.
Right.
It affects everybody's every decision.
Right.
Then you're going to distort.
So you're speaking outside observers. We have two outside observers on the panel. I want to turn at this point to Mr. Basil Ghalayini. He is the CEO and chairman of BMG Financial Group, which is a boutique investment firm based in Saudi Arabia, one of the best sort of in this region. When you advise your clients, you're looking at what we've just been talking about right now from the capital markets and the monetary policy perspective. You're looking at Europe. Do you want to invest in Europe? Are you comfortable in it? What are you looking for in terms of changes? What's sort of your outlook as an outside observer here?
Let me start by saying that an important fact that the Euro economies are quite linked to our region economy, the Gulf economies in Saudi Arabia, Kuwait, Qatar, Bahrain, and Oman. And let me talk about Saudi Arabia, be it the largest economy in the region. As we know, the Saudi government is planning for the biggest development exercise right now in the infrastructure, in the petrochemical and oil sector, in the transportation. And they are budgeting like $500 billion for that. 50% of those companies that are performing these projects are Europeans. Add to that, we have major companies that are marketing and having business with European clients in the petrochemical sector, in the mining sector, in the telecom sector, and others. So basically, what's happening in Europe is it will affect and it's affecting our region. At BMG, we advise sovereign funds, we advise high net worth individuals, and family offices. Before 2008, we would have a request every week, almost, for asking clients, our clients asking us to look for opportunities in Germany, in France, in Spain. Now, we get an opportunity from one of the investment banks there, and we will struggle to place it among our clients, unless it's very much distressed kind of company, or it's traded at a below market value compared with its peers, or it has certain synergy to our client's business, for example. But the picture is not the same anymore. And it's quite, my core business is basically to place good opportunities with my clients' capital, especially in Europe, because I lived in the UK for many years, and I basically have access to European opportunities where I can meet with Saudi capital and other region. So I think it is a bleak picture for us. And we are hoping certain measures and certain solutions could be taken on the individual countries level and on the Eurozone level as a whole.
Do you feel like you're getting mixed signals from European governments on the way that they're approaching financial instability right now? As we're just talking about, there's these challenges weighing different sides.
Okay, I represent the private sector, and we are getting mixed signals, to be honest. We are not sure which direction the Eurozone is heading, and the role of the IMF, the role of, the ECB, other institutions. We are basically now, or at least my clients are eyeing opportunities in Turkey, in the Far East, and in the certain regional countries. So again, we're not really sure how this crisis will evolve to.
Let's turn now to our last, but certainly not least, member of the panel, Mr. Andreas Rinker, managing partner at ZIB in Germany. And let's get more, maybe almost technical about sort of the value creation that comes out of sort of the financial sector and what we're missing because of all of this sort of financial instability. So as we're thinking about instability in Europe and elsewhere, what's sort of your assessment of the business climate that's within the financial services industry in Europe right now? What are the impacts of all this uncertainty and this crisis on value creation for banks and stability in Europe?
Yeah, thank you. Yeah, first of all, you've considered it. I'm from Germany, and this means in Germany, when I started with banking, it was in the early 80s, and even there, banking was considered to be very old economy. And somebody said, okay, we've had problems with the steel industry these times. And a very famous Deutsche banker said, okay, this will be, the banking industry in the 90s will be the steel industry of right now. And everybody was upset by saying this. But having got more than 20 years of experience, then you see this is rather true. And what we did is, being consultants for financial services as such, with 800 employees in 10 European countries, we focus on that. And I think you have to consider the role of the financial institutions when you go for solutions. It takes really more than one party to get a joint effort and to get the results we always wish to have in mind. So what we did is, just being not too smart and not to predict too many things, we did a study. Consultants always do studies when they don't know how to go on. And we did that with the performance of banking industries in the world. What we saw is everybody needs capital, but from a shareholder's perspective, banking is totally uninteresting. High risk, low chance, or better, low returns. This is what you have to face by then. If you look at it deeper, and we did that for the top 100, you see top performers that are really great, all coming from, let's say, countries with high growth rates, emerging countries. And the Turkish bank is one of them. And if my slides are not shown, I will not say who it is, just to make sure that you read the presentation. And there is no old European or US bank. These are all part of the, let's say, low performance sector. Why is that? Meaning growth region is a guarantee for performance? No, it's not. If you consider China, you have top performers and low performing banks all of a sudden. If you just compare growth rates to the banking performance, there is no significance, there's no significant link between that. But what you can learn, that there are several businesses, and this is, and maybe you can turn to slide 6, because this is not so easy to explain. If there's somebody who runs the presentation, just go to 6. Yes, that's fine. Then what we did is we went for the top quartiles and defined from the bottom quartile. What did banks better, who performed more? It was not just they had, that's fine. Thank you very much. They did not only fine, they were not only working in growth regions, they had a business model that was very close to clients, that was
more retail or corporate, and they were good in return on equity and return on assets, which means that they had business models that could be explained by clients. They had a strong growth, that's true. And can I show that? No, I can't show that here. They had a strong growth, and they were not that keen on risk. Sometimes old economies are very keen on risk. They had not that high leverage factors, meaning that what was in the balance sheet, it was fine, and they had capital which was good enough. So this is something we have in mind when we talk about financial stability. Then this is, don't forget about banks. Banks caused the first financial crisis. Banks need to know about their business models, and I met someone from the former West LB, which is one of the biggest, or which was one of the large banks in Germany. It is now called Portigon, a new name. Somebody said that this is, if you don't know how to go on with your old name, then you just change it. This is what they not did, but they are just decreasing in their thing. So knowing about own business modeling, knowing about where revenue comes from, let's say product, clients, branches, I don't know. Knowing about the risks is a key factor for banks to do their jobs in financial stability, and if they do their jobs, and Turkish banks are doing a great job with that, but even you should focus on becoming better in operational excellence and in, let's say, risk measuring and risk mitigating methods. So then this will be your part, if I may say that.
So one potential lack of incentive for financial institutions to pursue this would be this constant sort of environment of bailing out institutions globally. And something sort of you touched on, like the need for defaults. I don't, maybe you were speaking in terms of sovereign defaults or just of banks, maybe every bank in Spain. But maybe we can come back to that sort of in this context then. Is the need for there to be some defaults a requirement to really move past this crisis, to really move forward, is the title of this panel is about?
I think it's very simple. If I am to default, and if you help me not to default, then somebody is paying for me. It's as simple as that. Now, we had quantity using 1 QE, 1 QE, 2, now QE 3, it will be 4 and 5 probably. Where do we go? Interest rates in the developed in North America and Western Europe countries, the better ones are going towards zero. Will they become negative? They cannot, not anymore. So at the end of the day, eventually, monies will flow out of those countries to emerging economies and the selected ones. And that flow will reduce interest rates in those economies. And where will the money go? It seems to me that it's like the fish lives under the sea, under the water, and thinks that the whole world is made up of water. Some of them jump over the surface from time to time, but then they see the people around, they go back in. Okay. But there is life outside the water. We live outside the water. Okay. So I think we've become victims of the models we've assumed to be correct years ago, but the assumption has turned into a belief. And we don't challenge the models we are working in. I mean, all presentations here, my own, yours included, is basically a case in this point. I'll give you some numbers just to make a point in a couple of minutes. The value of total financial assets globally 2 years ago in 2010 was around $200 trillion total. East, west, north, south, globally. And this is estimated to be around double the value by 2020, 375, 380. Total value of financial assets. Currently, close to 20% of these monies are emerging markets, especially in advanced emerging economies like China, Russia, Brazil, Turkey, so on and so forth. By 2020, this will be more than 30%. So a transfer shift of capital. But strangely enough and dangerously enough, the share of equities in this total wealth 2 years ago was close to 30%. It will approach down to 20% by 2020. These are rough estimates, but show some mega trends. Okay? This implies an eventual equity gap of more than $10 trillion. Now, deleveraging is continuing. Interest rates are coming down. There is need for equity. I mean, all these three things do not add up. It doesn't balance. Something is missing. Okay? So I think we have to go to the fundamentals. Maybe after listening to Professor Yörükoğlu, go back and read the Irving Fisher's theory of interest one more time. What does interest rate stand for? Now, if everything is bank financed, just think of a hypothetical world, not to question everything you said. I mean, Central Bank of Turkey, you know, largely due to the works of people like Professor Yörükoğlu, is playing this management game very cleverly. I think the most clever policymakers are here. Not because in Turkey, but the results show that. That aside, if everything is bank finance, credit finance, trade credit, bank credit, shadow bank credit, whatever you call it, at the end of the day, it's all bank credit, one way or the other. Because a trade credit in my balance sheet is a bank credit in my supplier's balance sheet. It's the same thing, doesn't make any difference. Then, of course, banks are managed by smart people. They know the money business. The rate of interest they will charge is a function of, more than anything else, the risk they assume. And the risk is assumed is generated in the real economy. Production, sales, so on and so forth. So as a banker, I am not a dummy. I will determine my interest rate to get the profit away from the company. As simple, I assume the risk, I give you the money, so the profit should be mine. I'll give you some amount to pay for salaries and rent, so on and so forth. That's the way it has to be. Okay? But there's a small nuance here. As the wording goes, OPM, other people's money. The bank is leading other people's money to me, and that other people includes myself also. These are very fundamental questions and queries, but we have to ask them. To be more specific, I think we have to go to the good old days where we had a smart mixture of debt financing and equity financing. Personally, I don't see any long-term end to this financial turmoil other than remembering the merits of equity financing aside to debt financing. That has to be done. Because my debt becomes your debt becomes his debt, it keeps circulating, and each time it changes hands, we add an interest rate on top of it. That keeps growing. Okay, there is no end to that. I think we have to go, as policymakers, as regulators, as industry experts, as producers, manufacturers, merchants, whatever, we have to go back to the basics and re-question the way we model our businesses. I don't see any other end to this fortunes crisis, because if it were to happen 10 years from now, it would have been much more disastrous. I mean, that's my stand. As a regulator, as a person who's spent all his life as a free markets advocate, I have to say this, unfortunately.
So, and by the way, I don't think there's going to be a QE 4 and 5 because we're in QE infinity is the way that QE 3 was structured. It's just going to continue to go on for forever.
Until when?
Exactly. Yeah. So what's the investment perspective on this then? This idea of going back to fundamentals. Does this sound like it would create a market that would be more attractive? Is that an environment of what that would mean? That transitional process, is that a frightening idea? Is that
let me try to be.
Can we
please, okay. Just I'll add one more thing later.
Sure.
I think we should start some kind of educational process among our sovereign funds decision makers and certain high net worth family offices in the region, at least in our region, which they have the capital to spend, they have the liquidity thanks to the price of oil. And again, since we are not isolated from the Eurozone economies, and since we visit these countries, we deal with, we educate our sons so I think there is I think a moral obligation towards some of those sovereign funds and major institutions to invest in these countries' economies and industries, and not to rely heavily on borrowing and debt facilities. Also, I would encourage some of these companies to start comparing their prices with these of the Far East. For example, now it's very easy for a Korean or Chinese company to win a major contract, multi-billion-dollar contract in Saudi Arabia or any other Gulf country because of the cost per unit. So, and I was in a Saudi delegation to Italy recently, and we were in Milan Chamber of Commerce, and there were like 300 angry Italian businessmen complaining to the Saudis, why aren't you giving us, business? And, the answer is, it boils down to the bottom line. And those Koreans and Indians and Chinese are competing with you guys. So you really have to get your act together and recalculate your cost tables and your projects to make your companies more competitive.
Pointed towards some of the fundamental ideas we were talking about a little bit before. And I'll let you say something here, quick second. We do want to open this up to the audience. I'm actually not sure if there are cards that are being, questions are being written on, or if we're having people stand up. So if there is someone else in here that is more in charge than I am, that knows how that works, we want to open this up to you guys. So while that's getting straightened out, you were going to make a quick
Just
point.
Let me try to be a little bit technical.
A quick technical point.
A quick technical point. We always talk about an optimal way we finance a business, optimal capital structure where the cost of capital is minimized. Okay? In the good old days, as you increase your leverage ratio, the cost of capital goes down, hits a minimum, and then goes back up. You have an optimal. Okay? At those days, financial risks were manageable. Now, today, what we call financial risk is not the financial risk we talked about 20 years ago. We are not playing the risk game in the extreme event, in the tails of the events. Okay? There you don't have curves. You have curves jumping up and down. So you need an n-dimensional, to be a little bit technical, modeling of financial risk, which implies clearly that the optimal level of debt versus equity is a much lower leverage ratio than it was 20 years ago. That means equity and similar forms of financing. I don't mean exactly, certainly common stock, but equity. Equity means sharing of profits and losses and risk. You can't insure my house and make money if my house burns. That's not good. It doesn't work anyway. Okay? Sure. So we have to remodel things, rethink about the fundamentals. Other than that, we keep quantitative easing until we don't find a belt big enough to squeeze it again, because sure. easing, you can't find a belt to put it back in order. Sure. That doesn't work.
Okay, so we've got a microphone somewhere, so we can raise hands, and I will call. We've got right up here. If there is a microphone. If you speak very, very loudly, and then I'll repeat your question.
Well, thank you, moderator, and for discussion.
Here you go.
Thank you, moderator, and for discussion. I'm from Bangladesh. I'm managing director and CEO of City Brokerage. So recently, we have witnessed the benchmark interest rate in China and India, they have reduced below inflation. So how do you see in Turkish experience regarding the inflation and interest rate? Benchmark interest rate reduce in China and India to create more employment. That's because interest rate cannot come down below inflation. So how do you see Deputy Governor of Central Bank, Turkish? Thank you.
Thank you. Luckily, like India, China, Turkey doesn't have a growth problem. The banking sector is still small. Leverage is still small at the household level. And whenever actually interest rates go below some level, there is access to borrowing. There is huge demand for borrowing, like in India, in Turkey. So what we need to do is we need to actually, yes, our banking sector will grow. Maybe it will double in the next 10 years. And people have a chance to borrow. They can borrow more. Their income is also growing. But we should do this smoothly. For instance, 2 years ago, credit growth in Turkey was at a point in time, in 1 month, more than 50% year on year, annualized. So this credit growth is too rapid. So, as I said, these interest rates are very low for Turkish borrowers, households, especially consumers. We need to find ways to slow down credit growth, especially on consumer credit growth, and spread it to time. Maybe it shouldn't grow 35-50% a year. It should grow 10 to 15% a year. That's still a very nice growth. We also have high current account deficit, so that shouldn't put pressure, extra pressure. Credit growth shouldn't put extra pressure on our current account deficit. So we should spread this to time. That's what we are trying to do with our extra tools.
Andreas, did you want to get in on that point at all? How maybe this is impacting bank profitability?
No, I'm not an expert in inflation rate prediction. So I'm not an expert in prediction at all.
just the analysis of what's happened. Well, but maybe to that sense of how that has happened.
When I may add that, the idea of coming back to the fundamentals is a very good idea, because everybody's talking about growth, and I think the Deputy Prime Minister said, okay, we have growth rates by 3 or 4%. Which is not that what we were used to. But there is no way of, in these volatile markets, I think you have to be keen on that not every business is just done by how can we grow by more than 5%. This was something that the old economies, the old banking economies had to face, because the risks they took became higher and higher. The leverage factor became higher and higher, because with normal fundamental business, you couldn't produce growth rates that were expected by the markets, by the customers, by whatever. And so this is the good thing, especially when you are in a situation like Turkey is, with strong growth, with good fundamentals and all that stuff.
Right down here in the front, second row. And then behind.
Thank you very much. Peter Kaznachev from London. I have a question to Mr. Yörükoğlu. First of all, I was very impressed by your remarks, because I go to many different conferences, and this is the first time I hear a representative of a central bank authority arguing about the dangers of creation of credit on a bubble. I wish other representatives of central banks had the courage to say that. And I wonder whether, I'm sure you travel a lot as well, or you happen to be in the European Union, what the reaction to these warnings about the risks of artificially lowering or over-lowering the interest rate, what the reaction is. Thank you.
I'm sorry, whose reaction?
When you go to the European Union, politicians, central bankers, members of the government, ministers of the economy, and so on, decision makers, what do they think about your views? Because I totally agree with what you said. I'm just interested what other people, other colleagues of yours in other countries' reaction is to your views.
I think, especially now, after the crisis, everybody accepts that fast credit growth is not something good. It creates financial instability risks in the long run, both at the micro level and at the macro level. Fast credit growth is not something good. But we are lucky that we are lagging, we are following advanced economies. We see these their experiences also. So being the lagging economy, we are lucky in that sense. We can use these experiences in our tools, and now people are ready. I mean, if you tried to slow down credit before the crisis, at the boom days, 2005, 2006, before the crisis, you would face much more objections and a lot of lobbying against your policies. But now it's much easier because of the experience lived. So in that sense, we are luckier. Our job is easier compared to our advanced economy colleagues, counterparts.
I still think, though, that what you're saying speaks truth to what's going on in Europe. This is not just for Turkey. Actually, while you were giving your initial remarks, I was afraid that Mario Draghi would show up and cut power to the whole hotel, just to cut it off. We had a question.
As I said, this is my own views. I didn't.
Views.
No, I have a suggestion. Let these gentlemen run the ECB and you solve the problem.
There you go.
My view as a world citizen.
Yes. Not an official position of
Not
the
official,
Capital Markets Board. Right.
I'm securities anyway.
Okay.
Thank you.
And then one more question.
Thank you. I have 3 questions. Number 1 is, due to uncertain global growth prospects, particularly in the Europe due to the unfolding sovereign debt crisis, could be a decisive factor in the strategic change for the developing or underdeveloped countries. This is 1. 2, while making the monetary policy paper, do you think that the stakeholders' consultation is crucial for finalizing of such a policy document, which generally underdeveloped or developing countries doesn't observe these consultations? The last one is that assuming that the more proactive role in the desirable, what monetary policy should react to what extent it should be combined with macro-prudential regulations and possibly capital controls, and to what extent?
That's a lot. Oftentimes when testifying before the U.S. Congress, you get a lot of these questions. They say, "Well, I'll give you the answers to those in writing," because they're going to be more detailed. Maybe a very quick response.
Yes. So European economies, sluggish economic behavior, sluggish growth, has been a problem for us because we've been exporting, as our Deputy Prime Minister stated, a significant portion, close to 60% of our exports used to be to Europe. But our exporters are very successful in redirecting their exports. So it's now 40%. The Europeans share 40%. The good thing is this has given a chance and forced our exporters to direct their attention to the markets that has potential to grow. So this force is good for the long run. And one big problem for us is, like in other emerging economies, is the pressure on the relative price of energy, food, and commodities. But other than these, we don't see any problem in our core inflation. But as I said, low interest rates globally is a challenge for emerging economy central bankers.
I don't want to keep everybody from lunch, but I'll field one more question since we got pushed over and we want to take at least 1 hour. We've got these guys right here. So was there one more question before we go right over here across the room? Maybe we can throw the microphone. That's a bad idea.
Hello and thank you. I have two questions actually. My first question is to Mr. Rinker. How do you see the future of the banking in general? What I'm asking especially, this increased need and talk about the regulations and more involvement of the, let's say, other decision makers into the banking sector. Are we going to see more and more the so-called narrow banking in the future? That is, the banks are not taking too risky projects, and well, it's previously like the sovereign debt was like risk-free, but now it's debatable too. So, do you see in the future the narrow banking in the global banking system? And my second question is to Mr. Akgiray. As I understand,
which will need to be the last of the panel due to time constraints.
Okay. As I understand, you are advocating more equity financing instead of more debt financing. Now, there is this theoretical issue. One of the functions of the banking system is the liquidity transformation. So basically, it's, in short, financing long-term projects with short-term financing, and at the same time, basically it can offer to the short-term consumption needs of the depositors. Now, equity financing, in theory, looks lacks of, missing this part. So what do you suggest in kind of making this more balanced equity financing instead of debt financing in terms of this functioning of the bank?
So,
thank you.
So here we're going to have 15-second wisdom. 15-second wisdom.
15 seconds for me. Yes, I see more focused business models in bank. I don't know whether this size is not a matter at all. And I think for gaining funds, you have to have a story that shows the necessity why you go for clients, which clients that are, and the story for someone who gives you the money, and this is how you should focus on. Size is not a matter anymore, and the link to the customers and the customers' need will come up. And I don't know whether this leads to more banks or less banks, because some are dying, the sector's changing. This is what we see for the future.
Well, the financing of long-term investments by short-term savings is a major function of financial markets, not banking only. Regarding equity financing, if you have operationally and informationally efficient stock markets, exchanges, then equity is the most liquid thing in the world. Think of credit versus equity. If you default, what happened to your liquidity? Liquid. The water is gone and the glass is gone also. But if you have an efficient stock exchange, equity exchange, whatever you call it, a securities exchange, then you got the best liquidity you want, because you can always enter and exit. That's the must of it. So when we promote equity financing, not as an alternative, as a complement to credit financing, obviously, we are also challenging ourselves in that we have to have, like in the 60s and 70s and 80s partly, operationally efficient stock exchange, stock markets, efficient, where you can buy and sell, you get the maximum liquidity. That's a must, obviously. That's the best type of market. About the future of banking, I don't see my future in banking, but I don't know if somebody sees the future of banking, I will be happy to listen to it. Thank you very much.
They would make a lot of money. Let's thank this panel for all this great information. And thank the translators if you see them as well.
We'd like to thank the distinguished panel. Panelistlere teşekkür ederken IFS esnasında tarihi de bir ana şahit olacağız gibi gözüküyor. İstanbul ve Bahreyn borsası arasındaki mutabakat zaptı imzalanacak efendim. Dolayısıyla ufak bir sahne dekor değişiminin ardından İstanbul ve Bahreyn borsa başkanlarını sahnemize davet ediyor olacağız. Thanks a lot. Thank you. Olur. İmza törenimiz için basın mensupları ve değerli misafirlerimizin salonda kalmalarını rica ediyoruz. May we kindly request distinguished members of the press and our guests to remain in the room for the signing ceremony between Istanbul and Bahrain stock exchanges. Efendim, İstanbul Menkul Kıymetler Borsası ve Bahreyn Borsası ile mutabakat zaptı imzalama törenine geçiyoruz. Mutabakat zaptı töreni için İMKB Başkanı İbrahim Turan, Bahreyn Borsası Başkanı Fuad Abdurrahman Raşid ve SPK Başkanı Vedat Akgiray sahnede yerlerini aldılar efendim. Fotoğraf çekimleri için sizleri öne alabiliriz. Kameralara mani olmayacak şekilde fotoğraflar alabilirsek arkadaşlar. IOSCO Başkan Yardımcısı sıfatıyla SPK Başkanımız Vedat Akgiray yerini aldılar efendim, onu da hatırlatalım. Öndeki arkadaşlarımızı oturmaya davet edelim. Kameralarda görüntü alabilsin arkadaşlar.